Well, good afternoon. We are going to cover chapters 15, or excuse me, chapters 16, 17, and 18. Chapter 16 being the last of our marketing chapters that we did not address last week. That is using effective promotions. And then we'll go to chapter 17, financial accounting, and chapter 18, managerial accounting. So let's look at the learning outcomes that we want their learning objectives for chapter 16. Identify the new and traditional tools that make up the promotion mix. Contrast the advantages and disadvantages of various advertising media, including the internet and social media. Illustrate the steps in the business to business and the business to consumer selling processes. I'll read just a second till I get to the right place here. Describe the role of public relations department and show how publicity fits that role. Assess the various, just a second here, the effectiveness of various forms of sales promotion, including sampling, and finally, show how word of mouth, viral marketing, blogging, podcasting, email marketing, and mobile marketing work. Quite a mouthful, and we'll try to cover all of that. This particular slide, the promotion mix, can be found at the bottom of page 448. And I'll see if I can blow this up a little bit, if possible. See if we can get this larger so you can see this. Perhaps if we move it down a little bit. There we go. I don't know how well that will show up for you, those of you who join, or how well it will show up in the recorded lecture tomorrow for you when it's uploaded to Campus Web. But you can see it down here at the bottom. Promotion mix, combination of promotional tools that an organization uses. And this is what the mix includes. And let's look at this. Personal selling. We know what that is. That's somebody coming and proverbially knocking on somebody's door and showing what they have for sale, a piece of equipment or maybe a brochure or something of that nature. And in sales promotion, obviously that's promoting sales in a different way, if you would. Public relations, which we'll address, and then advertising. Now, this is the integrative marketing communication. Integrated marketing communication, also known as IMC, which combines the promotional tools into a comprehensive strategy. So you don't have different pieces telling different parts of the story at different times to different segments of your target audience, if you will, or for an audience that you're trying to attract. Notice that the first things it wants to do is to create a positive image. Now, it mentions the term brand here. And we normally think of brand as something like Coca-Cola or Pepsi-Cola, Budweiser, something of that nature. A brand may not necessarily be a product. And if you look at the advertising, informing, persuading, and reminding at the bottom of page 449, figure 16.3, different types of, excuse me just a second, I just lost my train of thought. Different, it calls it major categories in advertising. You'll see that there are brands that are mentioned there that are not things that we can pick up and hold. For instance, I Love New York with a heart there in New York. Virginia is for lovers. There are a couple other ones that are mentioned there. So a brand is being promoted, but it's not brand in the traditional sense. Meeting the needs of those to whom you're trying to sell. remember that a purchaser either has a need or a want, and he or she wants that purchase to satisfy that need or want, and then meeting the goals of the firm. Now, these are the steps in the promotional campaign, and they're fairly easy to understand here. And I'm not going to go through each of these because you can read them, you can understand them, you can get that from reading the text. You can look tomorrow when the the lecture is uploaded. And I think the first thing is you're going to have to identify who you're going after, and then to make sure you have a unified message. It says unifying, that's okay, we'll use that word. The other things in there go along with what you would do, and anytime you're going through a decision-making process or you're developing a plan. You have to know who your target audience is, what you're trying to reach, what your overall goal is, and the objectives to get there. Obviously, you have to have a budget. Perhaps the advertising promotion section within an organization has a budget. And I shouldn't say perhaps, they normally do, and then they have to determine out of that budget how much to allocate for this particular thing that they're doing if that decision is not made at the higher echelons of the company. And then you have to implement the plan. Now, the one thing that needs to go with this that's not mentioned here, and that is you have to evaluate the plan. You have to come back and see if that plan is working. You may need to tweak the plan if you find out that it's not. The next gives some classic campaigns, and notice what the subline is. They're brilliant marketing ideas. And I think the one that probably would resonates with me the most is this Clairol message here. Does she or doesn't she? Notice what they say there at the side. It was a provocative ad because of how it led into the promotion for advertising for Clairol. Now, we need to look at this advertising in the firm and decide, remember what advertising is. And we have to keep this in our mind because we don't think about it this way. It is paid, non-personal communication. Now, even when you have a pitch person doing something, somebody we can identify with, a sports star, a movie star, someone else, that is still non-personal. While it appears that the pitch person is trying to get you as an individual, it is not personal. And then notice it goes to various types of media by organizations and individuals who are somehow identified with the message being delivered. That's the pitch person. So we think of, well, I can't think of anybody right off the bat. Well, yeah, I can't think of a former football player, Brett Favre, who advertises a brand of jeans. I'm not going to tell you which brand because I don't remember which brand, but I see him often enough that he does that. And this is what, there are three major goals of advertising. And we don't think about the first one, and that's to tell us about the product, get us some information, then to try to get us to make a purchase decision and or remind us that we need to buy that product. These are the major categories of advertising. And notice here where they are. They are retail, trade, business to business, institutional, and product. I'm not going to go through each of those because you can see them, you can read them. This will be on the uploaded lecture tomorrow, so you can see that for yourself. So we don't need to spend a lot of time on this. But this is the category on the left, and what it is on the right, and then how we're trying to reach people. Now, this particular slide, we do want to talk about major categories in advertising. Major categories of advertising. And this is a little bit different from what we showed before. Before we were talking about organizations that do the advertising. This is a different scenario of the advertising. Advocacy, comparative, interactive, online, and mobile. And advocacy is normally we think of advocacy as being a quote unquote political message or a message for the government, which is not necessarily political. There were some messages that were sent advertised toward the middle of November, maybe a little bit early, toward sometime in December, reminding people that if they wanted to augment their Medicare coverage, that they needed to sign up by a certain date. So that was an advocacy type thing. We know what comparative is. We know what interactive is. So we don't need to go through all of these and make some long-winded statements about them, because we have them in our mind, we have an idea. But I did want to talk about advocacy, because that normally is not related to a product. It is normally related to an issue, some type of government information, or something of that nature. This particular slide, and you can see this graphically displayed on page 450 at the top of the page, figure 16.4. It gives you the idea and the millions of dollars of where advertising money is spent. And notice by far, television exceeds what we see. Now, as I want to stop back here and make a short point. As we know, television as we know it today is radically changing. Viewership of the commercial networks, NBC, CBS, ABC, and Fox, has declined. In some cases, the viewership in cable has also declined because younger folks don't want to pay those prices, and they're into streaming and things of that nature. And so that's an interesting dynamic. How much that will change the advertising for TV, I don't know. One of the things with TV is it's not an interactive medium. And so you do not know, you Mr. or Miss Advertiser, do not know if your message is resonating with the people you're trying to attract. Then we have direct mail, digital, newspapers, radio, etc. And this is just some steps on launching a direct mail campaign. Some things that you need to do. Obviously, you have to have a plan. Make sure you get the right list that you want that has the people that you're trying to attract. And then two things that are very important. One is the advertisement that you're trying to get across that you want people to pay attention to has to be distinctive. It can't be me too. People need to be able to remember that. And then the next game is also one mailing is often not enough, so you're going to have to follow up. This is just a advertising slogan, match the company with the slogan. I'm not going to spend any time on this, but a couple of things. Everybody doesn't like something, but nobody doesn't like Sara Lee. With a name like Smucker's, it has to be good. Jelly, good to the last drop. I don't know if we hear that too much anymore, Maxwell House Coffee, but that's just a couple of them. This next is the thing about a dog's life. These are famous animals, some real, some not real, who appeared in commercials for many years. The reason I say some real and some not real is the Nipper dog that was with the RCA for many years. When we had old things like phonograph records, RCA made them, there would be a picture of Nipper listening to his master's voice through a megaphone that was on the RCA label. Well, Nipper was actually somebody's dog, and so Nipper, even though Nipper was a caricature, it was somebody's dog, and it was used as kind of a prop till they got the thing down where they wanted it. Some of the rest of these, I'm not so sure about it. That Duke and Bush Beans may also be a real dog. We see him as a real dog. Whether it belongs to someone or not, I really don't know. So we can move on from that. These are popular advertising in media, or popular advertising media. We've talked a little bit about this. One of the things I think we need to look at here is this, notice here, a product placement. That's where we see this quite often and we don't even think about it. We see it in movies, we certainly see it in TV, where a company, but we're talking about the advertising arm of the company, will pay to have their product pictured somewhere. Notice here on the screen we see Coca-Cola. There's a beer bottle here in the back, or at least it looks like a beer bottle to me. I don't know who that belongs to, but these are some things that certainly we see. This particular slide this talks about what the cost of various advertising campaigns are. I'm not going to spend any time on that. Let's go to the next one. Infomercials. We know what those are. It is, notice here, it is a program. It says full length. Normally speaking, infomercials are 30 minutes. I don't know that anybody can stand more than 30 minutes of them. 30 minutes may be even too long. And then online ads and an interactive promotion, and where a dialogue is started between the marketer and a potential customer. This next slide just talks about the Infomercial Hall of Fame. I'm not going to spend any more time on it than what we see right here. We've talked about bad websites in the past, and I'm not going to spend a lot of time on this, but online websites have to be careful about turning or not to turn off customers. So I think what the message you want to get across here is that users want fast, reliable sites, and it's something that needs to resonate with people. Otherwise, they're not going to visit the site again and not going to come back to the site. This is just telling us that celebrities sometimes do this pay-per-tweet. Notice mentioning a product on site or in their tweets, et cetera, et cetera. That's just their information. I'm not going to dwell on that. Notice here that different companies monitor their ad effectiveness. So Dr. Pepper posts its message on Facebook and then monitors it. Richard Branson, who is the founder of Virgin Airlines and several other entrepreneurial enterprises, and Tony Hsieh, now I'm not sure I'm pronouncing his name correctly, the founder of Zappos, tweet their customer base to maintain two-way communication. So they initiate it, they're looking for something to come back, gives them some kind of an idea of how well their product is being viewed, used, etc. This is just here again talking about protecting yourself. Don't give out information unless it's necessary. I would say don't give out any information unless you initiated the contact. And be careful about URLs. Don't answer things from people that you don't know them. Now, this is just something that Kraft is doing with Oreo cookies. Oreo cookies have been a staple American snack for many years, but Oreos are now being sold outside the United States. And what Kraft is trying to do in advertising to get people into enjoying Oreo cookies. This is a little bit more, and here we're talking about global advertising. We're talking about a product that is well known in women for makeup and things of that nature, CoverGirl. And notice a single product and promotional strategy to implement worldwide. That's not easy to do. And one of the reasons it's not easy to do is because we have language transfer difficulties. I used the word transfer instead of translation. And what I simply mean by that is some words don't easily transfer from one language to another with the same meaning. And we talked about some time ago about corporations sending bad messages. And it was okay in the original language, but not okay when it was translated. That's kind of what this says. And we have to be very, very careful. Advertisers, companies have to be very careful when crafting their message, especially when they're trying to reach targets outside the normal area. A normal area here, I mean, I'm specifically talking about the United States. Personal selling, we know what personal selling is. As I mentioned earlier on, it's when somebody comes and knocks on your door and tries to make a pitch. Now, obviously, that's a little bit of an exaggeration, and I'm using a little bit of a license with the language here. But it is when somebody actually meets you face to face, personal selling face to face, and tries to make a transaction with you. And notice one of the things that it says about salespeople, one of the things that they do in personal selling is try to find new contacts. And they would say something else. Who of your friends do you think might be interested in this product? And that's how they try to build their customer database. Notice what salespeople need to do. They need to listen and to make sure that the product that they're trying to sell either satisfies a want or need, and notice to make the transaction as simple as possible. So you don't want to be overselling, and you don't want somebody to be distracted from what you're trying to say. If you make the message complicated, people are not going to listen. Now, these are successful selling strategies. I'm not going to go through all of this with each of you. Excuse me, I'm not going to go through each one of these with you. They're pretty self-explanatory, but I would like to highlight three of them. Know your competition. Because if you don't know your competition, if somebody brings up an objection and says, well, I like so-and-so better than this, or I'm used to using so-and-so, and you don't know the competition, its pluses and its minuses, then you can't respond to that. Sell to people who are most likely to buy. Now, what's the deal with this? Well, let's say you're selling to a business, and you have a great relationship with the buyer, the purchaser's executive assistant, secretary if you prefer, administrative assistant if you prefer. But you don't have a very good relation with him. Now you've got to work, or her, you've got to work on that. You need to continue to have a good relationship with the executive assistant because that person is your gatekeeper. That person is going to get you in the office or help get you in the office. But then you don't want to sell that person. You want to sell the person who has the ability to make the buy, the purchase. Build relationships. And that's talking about what I just mentioned about with having a good relationship with the executive assistant. But that you got to go further than that because you've got to get into the person who has the authority to make the purchase. And the executive assistant normally does not. These are some sales slip-ups. And there's a couple of things here that are very important. Remember, one is seeing sales as just a job. Remember, when you're selling something, you're trying to satisfy a need or a want the individual has. So you're trying to help the individual. Now, that may sound strange. You know, you think of all the salespeople you met in your life, and some you'd like to throw out the door, and the other ones you thought were pretty decent, that they're actually trying to help you. And the fact of the matter is they are, if they're really doing their job correctly. Not being yourself, not being prepared, and then not building relationships. These are the steps in the selling process. This is the business to consumer selling process, and we'll see that the business to business selling process is slightly different. So notice these are stairs, and what I would say to you, kind of like Maslow's theory of hierarchy, you kind of have to satisfy one before you can move up that ladder. And you know, you make a presentation, you close the sale, and you follow up. You come back and make sure things are working in a way that the customer wants them to work. But there are other things here that you have to do, and they're too important. I mean, you have to make an approach, so you have to have a good entree here to the customer, but you have to ask questions. You have to know where the customer is at that particular time. Is he or she receptive to making a purchase? And you'll find that out by asking questions. Now, public relations is a lot different than advertising. Here we're trying to gauge the public's mood and whether or not they're interested in changing policies, or whether you have to change policies in response to the public, and then execute a program of information to get the public to understand and then to accept your message. So the good public relations promotion program, you have to listen to your audience. You have to change policies and procedures based upon what your audience is telling you. If in fact you need to, you may not need to. And then let people know that you're going to respond to their needs. So it's like the old suggestion box we used to see in many companies years ago. And we soon found out that we wouldn't put any more suggestions in the suggestion box because they weren't listened to. They weren't acted upon. Nobody at least came and said, well, we got this and we can't implement it because. Just that's all it was. So we didn't do that anymore. That's what this is saying here. Now, what are the disadvantages over publicity? Whoops, excuse me. I went by publicity and I did not mean to do that. Publicity, notice, is information about a product, a service, or something else that is distributed to various arms of the media, but it's not controlled by the person or persons that send this promotional message out, this publicity. So you're trying to get that information before your audience, but you have no control over because it's not paid for. That's key there. You have no control over when it's going to be aired or seen. Many times you'll turn on the radio, for instance. I'm not so much sure about TV. I'm sure it's on there, but I haven't seen that a lot. You turn on the radio and you'll hear a piece of publicity for something, and it's on at 6 o'clock in the morning or 7 o'clock in the morning when most of the listeners are probably either in the shower or shaving or doing something else, which is not listening to the radio. There are some advantages of this. First of all, because it's not paid for, it's free. You just send it out and hope that somebody's going to take it and put it on the air or put it in their newspaper or whatever. Notice that it reaches people who would not normally look at this particular thing as an advertisement. And because of how it's seen or heard or read in the paper, it's more believable than advertising. Strange to listen to think, but advertising. Well, here's some disadvantages that we kind of talked about. When you have no control over when the message is going to be aired, seen, whatever. It can be either good or bad. And once that piece of advertisement, public relations, is completed, it's likely not to be seen, heard, or read again. Now let's look at sales promotions. Notice here what it does. Stimulates customer purchasing and dealer interest by means of short-term activities. We either have business-to-business sales promotions or consumer sales promotions. Now, let's look at some of the advantages and disadvantages of sales promotion techniques. These are more what we do and how we do it, as opposed to what I said are advantages and disadvantages. And you can see this in your text, figure 16.7 at the top of page 462. Business to business, these are the traditional type things that do, trade shows, etc. And then business to consumer, coupons, sampling, premiums, etc. We in the business and the consumer arena are familiar with these things. And this is what we just talked about, some of it, although we have some other ones in here, in-store displays and contests, demonstrations, etc. And these are coupons, which I'm not going to discuss a whole lot. We know a lot about coupons, and we won't go any further than that. Now, this is still one of the most effective types of advertising And I need to get to the right place here. Well, I'll get to the right place if I go in the right direction. This is still one of the most effective types of advertising, or promotion, word of mouth. And what it lists down here are the types of businesses that normally rely on word of mouth or use word of mouth quite frequently. The word of mouth cuts both ways. If there's a positive and a friend of yours tells you about it, and you trust a friend, etc., your chances of trying that are rather high. If your friend tells you to avoid it, the chances are equally high that you're going to avoid that. But it's still effective. Companies using social media sites, we know that that's increasing. And I'm not going to spend a lot of time on that other than to let you know that it is effective. The gentleman that started Facebook, Mark Zuckerberg, I read in the New York Times, is now considered to be the 5th richest person in the world. He's very young, and Facebook's not been around a long period of time. These are some other promotional tools that are finding their way into us, viral marketing. Notice you're paying customers to say nice things. I'm a little leery about that. I have to tell you, if I want to say something nice about a company, I'll need to be paid to say it. But I guess what they're saying is that they found somebody who is a positive advocate, and they want to pay them for their services. I still have a little problem with that, although if I put it that way, it's a little bit better. Blogs and podcasts and email, this is a continuing thing. Mobile media, which we know about, we're talking about Facebook and Twitter, and there's some other ones also doing things that are getting people interested in what you're selling. And then finally, you have two types of methods, if you will, for promotional strategy. One's a push strategy. Those push strategy and pull strategies are kind of reverse of each other. And then we have a pick, which is a little bit different. Push is obviously what it says, getting your product out there, using selling and advertising to get the space that you need to display your products. Pull strategy, on the other hand, directs heavy advertising and sales promotions toward us, toward a consumer. And so the object there is for you, Mr. or Miss Consumer, to go to the vendor, whoever that happens to be, person that's going to be able to sell you the product. Hey, put this on your shelves. I'm looking for you guys. Don't sell this. One of the effective pull strategies that we've seen lately is advertisements for drugs that can only be obtained by prescription. And the object there is to get you interested in that. If you have something that this particular drug is going to help you with, diabetes is a big deal, and people with having to use blood thinners and things of that nature. High blood pressure is another one, cholesterol is another one. To see your family physician and say, hey, doc, how come you don't recommend this particular drug to me? So that's the pull. And then pick economy, on the other hand, these are consumers who picked their products from online outlets. Well, that brings us to 512. We're finished with chapter 16. We will move into the accounting realm in chapters 17 and 18. And let's take a 4-minute break and come back at 516. Thank you. Please come back at 516 and we'll do chapter 17. All right, 516, we're back. We're going to chapter 17, understanding accounting and financial information. Some of the slide may not show up if you're watching here. I'm going to try to move it up when I can. I can't always do that for some. I just tried here a second ago and found out I couldn't use it. I'm going to try to move this over a little bit. Maybe it doesn't look like it's going to allow me, but anyway, we'll move along. So let's look at our learning objectives for this chapter, chapter 17. Yeah, I don't know why that's down there like that. Maybe I can. All right. I apologize. It's not going to cooperate with me, and I'm really not too sure why. Demonstrate the role that accounting and financial information play for a business and its stakeholders. Identify the different disciplines within the accounting profession. List the steps in the accounting cycle, distinguish between accounting and bookkeeping, and explain how computers are used in accounting. And the final two, explain how the major financial statements differ, and then demonstrate the application of ratio analysis in reporting financial information. Okay, what is accounting? Accounting is simply recording the information you have about accounts receivable or something of that nature, classifying it, summarizing it, and then interpreting it, saying what it means, and then provide interested parties the needed financial information. And the second part of that, outside parties include employees, owners, creditors, unions, investors, etc. This particular slide, we can see here also in the text, figure 17.1 at the top of page 475. We have inputs on the left-hand side. We'll come back to that. Then we have processing. That's what we're going to do. And then we're going to have the outputs. Inputs are things like sales documents, purchasing documents, payroll records, etc. Processing, what we're doing here was we're simply taking that information and transferring it to a ledger in some cases, and we're making mathematical sense out of it, if you will. So we're taking a document that has some the input that has some math to it, some figures to it, but also may have some written information, etc. And we're transferring that over as simply a figure, although, pardon me, we're identifying it in some fashion. Something we sold, something we purchased, this is payroll, etc. And then we're going to take that information eventually and produce some outputs. And these are our financial statements. And you can see these again in figure 17.1. Things like the balance sheet, the income statement, a statement of cash flow, etc. Very important pieces of information for any business. Now, unfortunately, this slide does not come down far enough, and I really apologize for that. I can't seem to get these to come down. Let me see if I can. It's not going to let me come down any. And that one is not either. So what we see here, financial accountants' responsibilities are things that they have to do. Notice that, I'm sorry, I'm going to try to blow this up if I can so I can see it better, so I can give you what it is. Not working. Let me do it this way. See if I move it down. There we go. That'll get us a little bit better. Notice what their responsibilities are: cash management, forecasting, and things like strategy and planning, personal finance, etc. Not something you really need to worry about, but these are just things that they have to do. Managerial accounting, notice what it does is it provides information to managers. And in some cases, not only information, but some type of analysis to help them in the decision-making process. Notice what it's involved with: how much it costs us to produce, how much it costs us to market our product, preparation of our budgets, and then ways that we can minimize our tax liabilities. Now, I want you to pay attention to that: minimize tax liabilities. That does not mean to say we're not going to pay our tax. What it means to say is, what can we do to maybe shift some things around so we're not paying more than what we ought to be paying? Managerial accounting. Now, we'll talk more about managerial accounting in chapter 18. This chapter focuses on accounting information, financial accounting. Now, if you will look at figure 17.2 at the bottom of page 475, you'll show the users on the left-hand side of the accounting information, and then the type of report that they're generating. And I want to pay special attention to government and regulatory agencies and the required reports. The financial statements and the annual reports and quarterly reports, etc., are things that are required by the government, by the arm of the government, Securities and Exchange Commission, SEC, for publicly traded companies. Those are companies that sell stock over the major stock indexes in the United States, the NASDAQ and the the New York Stock Exchange. So this is what financial accounting does. Financial accounting, for the most part, is a company telling a company's story in dollars and cents, if you will. And it's almost always for outside agencies. And these are the questions that are answered by the financial accounting information that's provided. Is the company making a profit? Can the company pay its debt? Now, debt there, I'm speaking of, these are current accounts. So in other words, you would be paying your rent, utilities, cost for merchandise, etc. And then how much does the company actually owe in debt other than current expenses? So that's the ability to pay its bills. Let's look at those as current expenses. How much other debt does it have? Now, we know, and we'll find out in this chapter, the companies do take on debt. They take on debt for a number of reasons, and many of them are good reasons. And we'll talk about that as we go along. So, but a company can't have too much debt. Now, you look at a company like Apple, for instance, and I don't know what Apple's worth is today. Stock market took another big hit, so they lost some money there as well. But Apple has a lot of money, and it's sitting on a lot of money. And yet it still borrows money for some things that they want to do, and there are good reasons for that, and we'll talk about that when we get to that reason for using borrowed money to do certain things. And then the annual report simply gives the health of the organization. And not only that, what its expectations are. Does it expect to be able to go forward in the coming year? Now, this tells us ways that we lay people, if you will, can look at an annual report and understand it. Notice what it says, how to read it. Well, we can learn to read it, but if we don't learn how to read it and understand it, the reading part is irrelevant. So that's what that ought to say. Not only to read it, be able to understand it. So what we need to look at here is, what do the managers say? They say we're in pretty good shape or not so pretty good shape. And some people that are pretty good at reading can read between lines. Now, had people really read and paid attention to what, pardon me, what Enron was doing, they would find out the company was not as good a shape as it said it was. There are a few other ones. So what we have here are several things to pay attention to: balance sheet, income statement, and statement of cash flows. The last thing we have here is the auditor's opinion. And this to me is problematic. And what I want to say to you is problematic. I don't mean anybody's cheating. But if you hire the auditor, and the auditor is from outside, but you hire the auditor is working for you. And so how independent is that auditor? And that's what investors and people that need to know have to find out, because what was happening down at Enron was Arthur Andersen was not only the auditor, but Arthur Andersen was also providing business consulting services. Arthur Andersen does not exist today because of Enron. And government went out of its way, and I don't know how successful it's been, I'm talking about the United States government, to split this thing and tell companies, wait a minute, you can't be doing consulting work for a firm and auditing the firm at the same time. That's a conflict of interest. That's unethical. So we have to be careful about auditors' opinion and make sure we read it properly so we get the full understanding of what's being said to us. By the way, I am not condemning any auditors. Please do not think that I am. What I'm saying is that we need to be careful when we read the auditor's opinion. Public versus private accountants. Private accountants work for a single firm and other things there. Public accountants are those that are out on the street. You've got shingle hung out someplace and say, hey, bring your business to me. I can do your accounting work for you. Many of those people are CPAs, which we talk about in the next amount. These are people who have an accounting degree from a college or university, and they have done work beyond a minimum of a bachelor's degree. I was going to tell you what the requirement was here in Ohio, but there's a specified number of hours that have to be completed, college courses that have to be completed above and beyond a bachelor's degree before you can sit for the Certified Public Accountants exam. American Institute of Certified Public Accountants, and then notice there, you can take the exam after you've met the state's, whatever state it happens to be, requirements for both education and experience. I don't know the experience part. I do know that there's 25 additional hours or something like that sticks in my mind. Each state is a little bit different, but you can't do that until you met the requirement. You can't sit for the exam until you met the requirements. And by the way, the exam is very difficult. I've known people that have taken an exam a couple of times and not passed it, and finally passed it on their third go around. So it's not something you just take the exam and pass and you're home free. That doesn't work like that way. This talks about ways to improve accounting practices. And notice it says hire an independent firm for consulting. What that means is that the consulting firm has nothing to do with your accounting or your auditing. They're separate. And that's what got Arthur Andersen in trouble. And make sure that we have internal audits and people are keeping up and things of that nature. This act was a combination of the bill, which was enacted into law, was sponsored by Christopher Dodd, a senator from Connecticut, and Barney Frank, who was a representative from the state of Massachusetts for many years. Both of them served in Congress for many years. And this was just making auditing and oversighting a public accounting oversight board, increasing the power of that board to be able to take things into consideration. Unfortunately, there are many on Wall Street that are trying to water down the Dodd-Frank Act which has been around for a number of years. And what we find in government is that we bounce from crisis to crisis. And so we have a crisis and we come up with a solution to the crisis, and then things get better and they say, oh, well, we don't need that solution any longer. That was for something that was a crisis that happened many years ago. It's not going to return. Well, you know, that's just not true. It may not return in the exact way that we thought it would or thought it will, but it comes back. And there are people who are complaining today that we're finding some of the same type egregious practices that took Enron down, and WorldCom, and Adelphia, and a few other firms. And we need to be constantly on the lookout for that. What we hear on one side is we need more regulation. And then on the other side, we hear, well, we have too much regulation, too much red tape, too much rules and procedures and policies to follow. Yeah, that can be true, but we simply can't get along with laissez-faire government. It doesn't work. It's never worked. And I mean, that's ideal, but it doesn't happen. People are humans, and we have some people who are greedy humans. And unfortunately, they get around and they boil the barrel for the rest of everybody else. And then we go back to this other swing. We need more regulation. Is there a happy medium? I would hope that there is. I've never found one. But I would hope that there is somewhere along the line we stop the people on the one side saying we have too many regulations and stop the other people on the other side saying we need more regulation. Come someplace in the middle. But as I said, unfortunately, everybody doesn't act altruistically, and so we need regulation. I'll step down from my soapbox. All right. And we have some different things here. We know auditing is just reviewing the information that the company has made and the company, excuse me, not made, has provided so they can prepare the financial statements. Independent audit, and again, I have trouble with this. If you hire somebody to do that work, a person is working for you, and he or she is not independent. What they're saying here, however, is that you're hiring somebody from outside the firm and somebody who does not have a vested interest. And therefore, logic would tell us that you should get an unbiased report. Certified internal auditors, same as CPAs, except in a way, except they're internal auditors. They're not out working for the general public. Notice what they have to have: bachelor's degree, 2 years of experience in internal auditing, and then pass the exam administered by the Institute of Internal Auditors. Notice this second bullet, which stems from the first bullet, that fraud, that's, you know, double dealing, that's padding expense accounts and things of that nature, cost businesses. And it damages businesses' reputation if the fraud's found out. What the problem is that many people are not trained well enough to catch the fraud. I use an example. I live in Kentucky and lived in the city of Covington for many years. I have a son who still lives in Covington, owns the old family homestead. And a year and a half or 2 years ago, a fellow working for the city was found to have embezzled $800 some odd thousand. Now that's that's not a lot of money when we talk about millions and billions. But a city of roughly 45,000 people, and I don't know what their annual budget is, that's a significant amount of money. And one of the reasons that he was able to do this was there were not sufficient checks and balances. Checks required 2 signatures. In this case, they didn't. And so money went other places. The guy was a trusted employee for many years. What caused him to do that, I don't know. But it took somebody from the outside to finally figure out what was going on, and mostly because people looking at it weren't trained well enough to figure out that this was embezzlement, which is a type of fraud going on. We have some specialized accountants. I'm not going to go into this a whole lot. Tax accountants, obviously, that's what they do, prepare tax returns, etc., and maybe help develop tax strategies. And they're schooled in tax preparation, and they understand the laws. The laws change pretty frequently. Government and not-for-profit accounting. I did work for a nonprofit for a number of years, and we had an accountant come out and do our books every year. We were required to do it by the state of Ohio, and prepare a report which we had to send to the state every year to maintain the status, not only to maintain the status as a nonprofit, but also to comply with state law. Now we're going to talk about the accounting cycle. I'm going to blow this up just a little bit so you can see it a little better. The 6-step process, and you can see this in your text let me skip over here to the text, tell you where it is. Page 480, figure 17.4. It's at the top of the page of 480. So first thing, we're going to do some analysis of our source documents. So we talked about what those were before. Then we're going to record those into some kind of a journal or ledger. And then we're going to transfer the journal entries into the ledger. Then we're going to do what's known as the trial balance. And these 3 items on the right are the primary sources of information that is made available to the public. We're going to prepare the financial statements, which you see as the income statement. And then we're going to analyze the financial statements. And these 3 make up the balance. These are made up with what's known as the balance sheet, the income statement, and the statement of cash flow. These 3 really tell us the health of the organization. In bookkeeping, we are recording the business's transactions. And notice we divide them into meaningful categories and post them in a record book, our computer program. That's what most people use today, and it's known as a journal. Then we have what is known as double entry bookkeeping. We are recording the same information twice in 2 different places. So what this is a check and balance type thing, if you will. We're making sure that what we're doing is accurate. And next comes the bookkeeper's tools. I'm not going to talk a lot about this. The ledger we've already talked about, where everything is described, or the information is recorded. And then the trial balance, a summary of all the information in the account ledgers. Now, computerized, this is a computerized. I'm going to come back here just a second, see if we can do something a little different here. This is just technology in accounting. It talks about different types of programs that are available. QuickBooks is one, Peachtree is another. I'm not going to spend any time on that. But if you're in a small business, these things are known to small businesses, and you should purchase something that is reliable and meant for a small business. Now, financial statements, and we talked about these just a few minutes ago, a summary of all of our financial transactions that have occurred over a specified amount of time. Normally speaking, if you're a publicly traded company, those have to be reported quarterly and annually. A small business may do them monthly, quarterly, and annually. It doesn't make any difference how you do that, but you need to stay on a particular type schedule. And then the three elements that we have: the balance sheet, the income statement, and the statement of cash flows. Here's the fundamental statement, which is the basis of the balance sheet. And it must be balanced, and it has to be assets equal liabilities plus the owner's equity. Balance sheet tells us how we're doing at a certain time. Assets, these are, notice would say economic resources that are owned by the firm, be tangible or intangible. If they're liquid, it tells us how quickly we can convert them to cash. Assets are classified as current or fixed. Current items that can be converted into cash in 1 year. Fixed, those are things that are permanent. We're not going to be able to move them: land, buildings, equipment, etc. And intangibles are things like patents, trademarks, and things known as goodwill. Oftentimes you'll see a small business will be sold for X amount of dollars, and part of that is goodwill that the previous owner has built up with his customers and maybe suppliers and a few other type things. Liabilities, these are debts. We have to pay those. Accounts payable, this is current. Something that's come in, somebody provided a service or sold us something, we have to pay for that. Notes payable, we'll talk more about that a little bit later, but these are short and long-term liabilities that I promise to pay back to you at a certain time. And bonds, normally considered long-term, must be paid back, and interest must be paid when it's due. And again, that's something we'll talk about a little later. Owner's equity. This is the amount of the business that belongs to the owners minus any liabilities. And retained earnings are things we've kept within the company, and they're reinvested in the business. This tells us where we stand on a particular day, the income statement. It's going to tell us whether a profit or loss, etc. And we know what net income is. We know what net loss is. Now, this is the income statement. I'm going to bring this down just a little bit. And the income statement is going to tell us the revenue, that's what's come in, minus the cost of goods sold is going to equal our gross profit. And then operating expenses are net income before taxes minus taxes. That's going to give us either our net income or our net loss. On the accounts of the income statement, remember, revenue is what come in because of things that we've sold. services rendered or something else is coming to us from some other type payment. Cost of goods sold or manufactured. This takes into account what it costs us to manufacture, raw materials and supplies we've used in producing what we want to produce to sell to somebody else. Gross profit, our gross margin, is exactly that. It's how much we made by buying and selling merchandise. No expenses are taken at this particular time. There are two methods of accounting from what is known as GAAP, generally accepted accounting principles. Now, you can use a different type of inventory method, accounting for inventory method, excuse me. First in, first out, or last in, first out. However you do that's going to affect the inventory valuation, but you have to be consistent. You can't change in the middle of the course. Operating expenses, we know what those are. That's rent, utilities, etc., and then salaries and supplies. Depreciation is writing off the cost of a tangible piece of equipment over its estimated useful life. And there's usually a formula that comes along for that, and companies should follow the formula. Now, they can change that. They can accelerate it or they can decelerate it. But again, you have to be consistent. Statement of cash flow captures the three things that we do: operations, investment, and financing. It's important to understand the cash flow. And cash flow is simply a difference between what comes in and what goes out. And being able to manage cash flow is important for any business, particularly important and challenging for a small business. This is an ethical situation, and I'm not going to get into that. These are the financial ratios you use to help a company know its financial stability, liquidity, leverage, performance, and activity. The liquidity has two: their current ratio and the asset test ratio, and these are found on the company's balance sheet. Leverage ratios, also found on the company's balance sheet, include debt to owner's equity ratio. That's part of the leverage. A profitability ratio includes basic earnings per share, return on sales, return on equity. Also found on the balance sheet and on the income statement. Activity ratios, again, found on the balance sheet and the income statement. The key one here is inventory turnover. How effectively management is turning over inventory. You keep inventory too long, you're losing money. Now, this is just something that is coming along in the future. We hope we'll have a international finance reporting standards system. There's been some pushback from many businesses, although the Securities and Exchange Commission believes there ought to be a standard. This is a timeline to implement this. I don't think that we'll meet this in 2016. That brings us to the end of Chapter 17. Chapter 18 is managerial accounting, excuse me, and we'll move into that. It's 5:50. Please come back at 5:53. We'll take a short 3-minute break. All right, 553, we're back, Chapter 18, Managerial or Financial Management. So learning objectives for this chapter: explain the role and responsibilities of financial managers, outline the financial planning process, and explain the three key budgets in the financial plan. Explain why firms need operating funds, identify and describe different sources of short-term financing, and then do the same thing for long-term financing. So let's get into the mix here. Question posed here is, what's finance? This is the function of the business that acquires funds for a firm to operate, if that's necessary. For most firms it is, and then manages those funds for the firm. We also have financial activities of preparing budgets. Now, we need to think about this also as planning, and then preparing, creating the cash flow analysis, and then, planning for expenditures. And this is just simply what the financial management or financial manager's job. A large company known as the CFO, Chief Financial Officer, and he or she is to manage the firm's financial resources so the firm can meet its goals and objectives. These are what financial managers are responsible for doing: paying bills and collecting payment, making sure that they are abreast of market changes, and then making sure that the accounting is accurate. This is just telling you who's who in the finance world. We're not going to spend any time on that. Four signs that you need a CFO. Well, let's just take this away and say you need a financial manager. Every company's not large enough to have a CFO. You don't have enough information, so you can't about your finances. Nobody is paying attention to analyzing your financial resources or managing them. You are not staying abreast of regulatory changes, and you cannot, for some reason, generate the financial reports that are necessary. Now, we know that if you're a publicly traded firm, you have to make financial reports every quarter. Well, a small business doesn't have to do that. They're not required to do that, but they need to know where they stand. And if they don't know where they stand, they're going to be in big time trouble. Why do firms fail? Don't have enough money. They don't know where their money's going, and they don't control expenses. These are concerns for the person that manages the firm's finances. Doesn't have to be a CFO, remember that. Consumer demands something different. Government regulations. There's price competition. The credit markets and interest rates are not favorable. And then we have global financial instability, which right now we're experiencing. Financial planning. This is not something we do just by throwing cards into a hat and picking one out. We need to do long-term and short-term analysis of where we stand and how the money is coming in and going out. So we have to be able to forecast short-term and long-term financial needs. It will tell us later in the text, but we might as well get to it right now. Short-term are usually funds that a company needs for a year or less. Long-term for a year or more. The text talks about 2 to 10 years. that 10 years may be a little too long. Some companies don't want to go out that far. Some companies may try to go a little bit further if they can. And then having some controls in place to assure that the company is meeting its financial goals and objectives. And this just tells us where we go here. We talked about the short-term forecast and long-term forecast, but let's talk about the cash flow forecast because that's as important as the other two. This tells us how much is going to come in and how much is going to go out in a certain period of time. We can make it monthly, we can make it quarterly, we can make it annually. Notice it says usually months and quarters here, but we need to do an annual one as well. They come along with the quarters. Budgeting is simple. We try to make a forecast here. Now it says expectations. Forecast is just as good about what's going to come in. How much of this product are we going to be able to sell, or products are we going to be able to sell? And then from that, we're going to allocate resources. Say, okay, we got $1 million coming in. We have 10 departments. Each department is going to get $100,000 because we know we're going to sell something that's going to generate $1 million. Well, every department may not need to have $1 million, so the budget has to determine who is going to get what and how much. Now look what budgets depend upon: the balance sheet, the income statement, and the statement of cash flow, and then our forecast, long and short term. Notice what the budget is. It's a guide. It doesn't necessarily tell us we have to, but we have to be careful if we don't follow the guide. You know, it's just like I want to get a map and follow a map. And then you say, well, I'm not going to follow a map because I know a shortcut. What'd you get the map for in the first place? Now, of course, today automobiles have GPS and things of that nature, so we don't think about map as much. But that's something that we need to think about. We have a guide, we ought to follow it. Now see if I can blow this up just a tad so you can see a little better. Not quite. I'll come down one here. And we can see this graphically displayed, figure 18.2 at the bottom of page 507. That's financial planning. So we have the plan of what it's going to do. Notice what it comes from. It comes from the master budget or the operating budget. It's the same thing. It's just sometimes it's called differently. And from that we have cash budgets, financial controls, capital budget, and of course we have long-term and short-term forecasting up there at the top, which are not directly aligned with each of those, but play a big part with each of those. And then notice what we have from the financial controls. We have feedback. So we're telling people along the line, and even though this is not very well depicted here by lines, we're telling people this is the information we have coming in, and this information you need to know so you can do the things that you need to do or stop doing some things because the financial plan won't support it. Now this just talks about establishing financial control, and it really isn't anything earth-shattering on this slide. If you have a checkbook at home and you operate, you balance, you manage your own assets and liabilities. Assets would be a paycheck and maybe something coming in, you know, if you rent some piece of property out or something of that nature. So it's money coming into you and then money going out. And so you have some financial control, maybe not as elaborate as a company has, but what it says here, periodically examines its revenues versus costs and expenses. Now, you do that if you balance your checkbook. You should balance your checkbook. I hope that you do. And if you work with a good bank, you get a statement every month, and so you have some kind of an idea where you stand. That's exactly what this is. It's not any different. Maybe on a grander scale, maybe with more money, more assets, more revenue, more expenses, but it's the same principle. So you establish a control, and the bank helps you establish a control by giving you a monthly statement of your checking account or your financial institution, if you're with a credit union or a savings loan, whatever it happens to be. That's exactly what the company is doing, and they establish their own financial controls. These are the factors, and you can bring this over to your own home, your own household. Are we meeting our short-term commitments? Are we able to pay our bills? Do we have enough coming in as opposed to outflow? How are we financing our assets? Are we borrowing? And we don't like to do that at home, but that's what a company needs to think of. And are we giving our investors a reasonable rate of return? These are the needs for operational funds in a firm. And we've talked about these before in different ways, but we have to have money for day-to-day operations. We have to control credit, what our credit is. That's buying things, paying for them later. If somebody sells you something that says net 30 days, that means you're going to pay the invoice and you're going to pay it 30 days. That's credit. That's the same way as your credit card. If you make a purchase on your credit card, you're actually borrowing money, and you're telling whoever it is you borrowed from, your credit card company, I'm going to pay this back within whatever number of days they say it is. Otherwise, I'm going to pay interest. Well, that's exactly what this is. It's no different. Making sure we get the inventory we need, and then making the capital expenditures. Now, these are ways that small businesses, those are businesses identified by the Commerce Department as U.S. Department of Commerce as having 500 or less employees. Go after the people that owe you money. And there's nothing wrong with asking you to please pay the money. If you want to get your money quicker, you may think about offering a discount. Hey, pal, you pay me within 10 days and I'll give you 2%. In other words, if the bill is $100, I'll give you 2% of that, and I'll settle for $98 and I have my money quicker. If you have a vendor giving a special deal, take advantage of it. Raise prices, you got to be careful there. Do that as a last resort because that causes problems. Yeah, you can raise prices and lower them, but you really don't want to get into raising prices unless you absolutely have to. I'm not saying that they shouldn't be raised, but think about things that you could do without raising prices. And be careful using credit cards. That's the same way that you would do at home. That's a ethical situation there, which we're not going to get into and spend a lot of time on. But I do always encourage you to look at those. You can get some good ideas from that. Two types of financing: debt financing, where you borrow money, and we know that has to be repaid. And in some cases, it has to be repaid with interest, maybe in all cases. Equity financing, this is where we're raising funds through our own operations, or perhaps we sell a percentage of ownership in the firm, such as it mentions here as stock. So one takes on debt, but there are advantages to that, which we'll talk about later. The other one doesn't take on debt, and there are advantages to that as well, although there are disadvantages to both. Short-term financing, long-term financing, we've talked about this before in a different setting, and we're not going to discuss it here because it doesn't need to be mentioned anymore. Now, this particular slide, you can see this. I'll see if I blow this up just a little bit without losing it. Yeah, there we go. Short-term funds and then long-term funds. You can see this in your text, figure 18.5 at the top of page 513. Short-term are, things that we know we need right now. We need the money right now. Maybe monthly expenses. We have some type of emergency. We may have a cash flow problem, God forbid, because that means there's problems for the most part. So we have to be careful about that. Long-term funds are usually to buy major pieces of equipment, new product development as well. We might be merging or acquiring. And so we're going to need funds there. And then if we want to move to better facilities. So that's going to cost us more. So that's where those things come in and the differences between them. These are the types of short-term financing. Put that back up there. Trade credit. Remember, we talked about this before, as we're buying merchandise or buying things that we need to manufacture, and we're getting a credit because we're telling the seller we're going to pay you back in 30 days. And notice there's an incentive there to pay back within 30 days. Some you might be able to hold on to a little bit longer than 30 days. And a promissory note, this is where we get into an agreement with somebody by signing a contract saying you give us a certain amount of money and it will pay you back, and then we'll pay you interest on what is owed. Most likely, very seldom can you get a loan borrowing money, or as a friend of mine used to say, buying money. I want to buy some money, which means it was a loan without some type of interest payment. Many small businesses get short-term financing from friends and family. You have to be careful about that because that can create lots of problems. Make sure that both sides of this agreement are in agreement. It's important for you as the small business owner to get the money, and hopefully it's important for the lender, whether the lender is family or friend, to lend you that money. He or she's going to get something out of it, not just your continued friendship and not just the interest, but seeing you being able to succeed. You have to have specific loan agreement, specific loan amount and the term. It has to be in writing, can't be any other way. And then arrange to pay the same way that they would for a bank loan. So, if the bank loan is on demand, I don't know if you can still get those types of loans. You could take a loan for say 6 months, and then the bank says, "Hey, your money's due," and you go back to the bank and pay them the money plus whatever interest there is. If you can still do that, that's fine. But there needs to be some specificity there. Otherwise, you're liable to lose friends and family. It's difficult for a small business to get a loan from a bank, a short-term loan. They just don't like to do that. That's unfortunate because banks right now, of course, or stock market's taking a beating here since the first of the year. Banks have a lot of money, and they're sitting on a lot of money, but they're not lending it. They're specifically not lending it to the small business person because they're concerned they're going to get their money back. And that's exactly what the second bullet says. It's not something I'm going to get into here, threading the needle. This is something that's a little bit different, interesting, but we're not going to spend any time on. These are different types of short-term loans: secured, unsecured line of credit, and a revolving credit agreement. A secured is backed by some type of collateral, usually property, land, or something else. Unsecured is exactly what it says. It's not, the lender is actually giving it on good faith because he or she knows that the person who wants to borrow the money will pay it back. A line of credit, this is, notice, a given amount of money that banks can lend out as long as they have the funds available to do that. And a revolving credit agreement is the same as a line of credit, but it's guaranteed and it comes with a fee. Now, that's a fee over and above any interest. Factoring is a process that a lot of small companies use because they are in need of money, and they'll go to a factor and they'll sell their accounts receivable so they can get cash right off the bat. They can't usually do that with banks. Banks many times don't want that. Factors will charge more than a bank because many small businesses don't qualify for loans. So there's a yin and a yang there. You have to be careful about that. But the difference is, go to a factory, you can get your money and very quickly. Commercial paper, notice these are unsecured promissory notes. Remember, there's no collateral put up for that. And usually in amounts of $100,000 and are due in 9 months, 270 days. Notice that only financially stable firms are able to sell it, and they're only going to sell it to financially stable firms. Credit cards, I just tell you, if you're a small business operator, stay away from that. Although, if you remember watching the Pillow Pets video, they talked about using their credit cards. Those people were risk averse. They weren't worried about risk. They knew about it. They were willing to take it, thought they had a good product, and of course they've been a success. But I would tell anybody, be very careful about using credit cards. If you're disciplined enough to pay off the loan, remember that's what it is. It's a credit card, and by the date it's due, fine, go ahead. If you're not that disciplined, understand that credit card interest rates are extremely high, and it's going to cost you a lot of money. Some years ago, back in the early 1990s, when I was living in the Washington, D.C. area, there was a program on one of the local radio stations, money program that came on Saturday mornings. I used to listen to it occasionally. And the fellow that was in charge of the show talked about a credit card. And if you had taken $1,000 on a credit card and you only paid, now, by the way, this is 20 plus years ago, and you only paid the minimum amount due each month, it would take you 10 years to pay that off. So just think about that. And I don't know, that's 20 plus years ago. What it is today, I have no idea. Other ways to get startup capital, look for a microloan or microlender. We talked about talking to the Small Business Administration, the peer-to-peer lending, talk to your local banks, etc. Don't expect a lot of help from local banks. They're just not willing to do that these days. If you're talking to a small local bank, they may be willing, but the large lenders aren't. Now, this is setting long-term financial objectives. And these are the questions you need to ask yourself. You have to have goals and objectives. what funds do we need to achieve the goals and objectives, and what sources of long-term funding are available and which best fits our needs. So it's, you're just asking questions and you're answering them. The 5 C's of credit: character of the borrower, capacity to repay the loan, capital being invested in the business by the borrower, conditions of the economy and of the firm, and the collateral available. All right, long-term financing. And we've talked about this quite frequently. We're going to discuss a little bit more. Notice generally come due in 3 to 7 years, but may extend to 15 or 20. The loan agreement, you have a promissory note, and we have to repay when it's due, plus the interest when the interest is due. We have to remember that a major benefit of debt financing is that the interest rates are tax deductible. The interest, not interest rates, the interest we pay is tax deductible. Excuse me. Of course, you can do equity financing. You can do equity financing. You're not going to borrow money. You can sell some of your stock. You can use some of the profits you've got to reinvest in the firm. How you can attract venture capital. Now, the problem with venture capital and venture capitalists is this. And by the way, when I say this, I'm not demeaning these folks, but I want to let you know that if you want to go this route, those folks want their money when they want it. And so you have to be prepared for that. I have a good friend of mine who's in the security alarm business, and he has been for all the years that I've known him. Borrowed some money from a venture capitalist, and his firm was doing real well. And a venture capitalist came and said, "Hey, pal, we want our money back." Well, he wasn't in a position to pay it back, but and keep the firm going. So he had to do what he had to do. He had to liquidate. Paid his money back, but certainly wasn't what he wanted to see. These are the questions a venture capitalist asks. These are the differences between debt and equity financing, and it's something we need to pay a good deal of care to, and you can see this at figure 18.6 at the bottom of page 523. Leverage is raising funds through borrowing to increase the firm's rate of return. And we have to be careful the cost of capital rate of return a company must earn in order to meet demands of its lenders and expectations of equity holders. And this is using debt versus equity financing. A little bit different here than what we've seen. Pretty much the same though, if you look at it. So we have to look at stockholders' equity and et cetera, stockholders' debt, stockholders' equity, year-end earnings, et cetera, to decide whether or not we want to do that. And these are the lessons learned from the recent financial crisis, although we may find something similar shortly if the stock market doesn't resurrect itself and the global economy doesn't get better. Worst since the Great Depression, led to passage of sweeping financial reform, which we've talked about. People are trying to roll back, and the government is increasing involvement and intervention. Well, that brings us to the end of chapter 18, and the lecture question for this evening is, what are the uses of the cash flow statement, the balance sheet, and the income statement? Now let me repeat, what are the uses of the balance sheet, the income statement, and the statement of cash flows. That is the lecture discussion question for week 6. Again, what are the uses of the balance sheet, the income statement, and the statement of cash flows? So I thank you for your attention, and good night.